Well, after much persuasion, we finally managed to convince Maneesh Dangi, the bond king of Indian AMCs, to come and share his thoughts on where the bond market is headed, how should one choose asset allocation, and what is the right way to really understand valuations at a time when interest rates and cash flows are going to be, interest rates are going to be zero, and one can really hold on to assets largely because of the yield curve we are in. Maneesh, hope all's well with you, my friend. Good to see you. Good to connect with you again.
Well, thank you.
So, Maneesh, what is your understanding of the world? One side you've got huge economic crisis, and on the other side you've got financial markets which are celebrating as if a new economic boom has started.
I mean, the world around me is, at least the real world, the main street that we call it, is fairly scared of virus, and everyone is staying at home, at least in India, as of right now, fearing for life. But the financial markets have the way to sort of look through all of it, look at adjacent future and see how things will play out, and they're rejoiced by the fact that policymakers, both governments as well as, more importantly, monetary authorities, have actually played the ball. They've tried to sort of make it painless for them. This time the template that the policymakers have used is to sort of ensure that the COVID does not become painful for both labor market and financial market. They've tried to ensure that there is no reverse contamination of Main Street into Dalal Street or Wall Street. So to that extent, that's the kind of divergence that we are seeing right now. One, of course, the markets are looking through it, and two, they're happy that policymakers are actually backstopping them.
Maneesh, what is the end game of this liquidity-driven market? Because every time markets are going higher, when we ask experts, they say, no, it's not valuations, it is liquidity. And then we ask them that how long the game will continue. They said, look, as long as economic growth does not come back. So how does one understand investing in this environment when all the basic tenets of investing have been rebooted? Inflation, cost of capital, and also valuations.
Look, we sort of are in market-based economy, and policymakers take cues from markets as to how they're pricing, what they are pricing, and in a sense, to a certain extent, at least I would say, in Anglo-Saxon world, it's become the tenet of actually managing policies is to actually ensure that markets stay happy. Now, so that's one reason, of course, markets continue to soar. Now, how do you sort of explain this? Over last 30 odd years, interest rates across the world, more so in the developed worlds, have actually trended lower secularly, assisted by technology, assisted by the large capital being deployed in new tech. The inflation as such stays decimated for last many years, and which has resulted in lower interest rates, and which essentially sort of has led to this big boom in asset markets. They are pricing much lower interest rates than they used to price in the past. The real rates have actually come off quite substantially, and as such, even in this crisis, markets are seeing that the growth sacrifice won't be substantial, because at some point in time we will get through this virus, and economies will open up. Lots of pent-up demand would come alive, and net, it's a postponement of demand instead of demand destruction. So that's what markets are pricing right now.
Okay, you have talked a lot about how there's an expected bounce back, Maneesh, particularly in India as well, given certain factors that are working to our advantage. Just talk us through some of that, and also perhaps the pockets where you see the maximum strength. And I know there are a few of them, but even if we have a broad overview to start with, and then we can go into them in detail.
No, so Indian economy actually is quite badly hit right now as we speak, because our lockdowns have been sort of more severe than most parts of the world. And let's understand this, that it's not the virus which has affected the economy; it's the public policy response. And more severe the response is, worse the economy is affected. Now, to look at India in future, you ought to know what's going to happen to virus, how well will it be contained in our country, what sort of mortality we will have, and would there be a bounce back in Indian economy, given that we were already struggling in the run up to the COVID crisis. Now, the first on the virus, of course, as such, given that now we know across the world, but more specifically, some of the reports which have come out, the serological studies, talking of 15, 20, 30% of the population in the metros are affected already because of COVID-19. And that tells us that mortality is an order of magnitude lower than what was anticipated. So to that extent, now we know that, this is not a fatal disease, and it's very likely because of demographics. It's maybe perhaps because of the BCG vaccine or the malaria medicines that we had taken. Most probably the virus won't hurt Indian people as much as it did the Western countries. So most likely we will open up faster and without having much of a damage to our healthcare or the health of people. Okay, so that's one way to look at it. That most probably the last 3-4 months of lockdown will give into fairly open economy in next couple of months' time. I mean, I am not underestimating the virus would continue to spread. It's just that I'm making a point that the fatality rate of this virus is far, far lower than what was assumed. Perhaps as low as 0.1%, and not dramatically different from seasonal flu, at least in India's case. Second is that in Indian economy, I think economists have actually moved to the other extreme of being too bearish now. I think let's appreciate that where very large part of our economy is actually a rural economy. About 2/3 of our population lives in rural area, where in any case social distancing is practiced. That part of the economy is largely reliant on food economy, the agriculture economy, and actually that's not getting hurt at all. So to that extent, I think a fairly significant percentage of our population will remain somewhat unaffected, and they would also sort of bounce back fairly quickly. The other tenets of Indian economy, we are a young population, we are underinvested. We've almost had a lost decade for last 10, 12 years. We've not really invested, and we are fairly underinvested across economic parts that we see, and it's very likely that we would begin to see some sort of an investment revival in India. So my sense is that Indian economy would actually recover faster, and most probably by 22, 23, the total loss because of COVID-19 wouldn't be substantial. Here also, so I want to make a point here that many economists are thinking that there'll be a permanent or durable loss because of COVID-19 in the Indian economy. I don't think so. I think we will have a sort of a V-shaped recovery in 21, 22.
Okay, a V-shaped recovery, and that's something that we're all hoping to see for sure. To what extent do you feel infrastructure is going to be a critical part of that, Maneesh, given that it's probably been underplayed in the last few years? How important is it to see a focus there, expenditure, a kickstart to really see that growth come in?
I think, infrastructure will anchor the world economic revival as such. I think the governments are actually good at only 2 or 3 sort of spending. One is, of course, transferring to consumer or tax cuts. But alongside, only meaningful expenditure that they've shown that they're good at is actually building infrastructure. And as a matter of fact, pretty much whole of the world is actually underinvested in infrastructure. Mostly the developed world. US, you would argue that it's about 25, 30 years behind China in terms of the level of infrastructure they have. So I think, over next couple of years, I would see a substantial boom in infrastructure, across the world and also in India. India's infrastructure, of course, has improved over the last decade and a half. Yet, we are far, far behind. And given our ambitions of actually exporting from India, building an industrial hub in India, it's important, that we build infrastructure. So my sense is that I think the setting is good right now to sort of promote infrastructure. Now, Indian government then has tried hard for the last couple of years to ensure that it's a private enterprises who build infrastructure, and in some sense that's not been a very, very successful experiment here, and that's true across the world. Infrastructure is generally built by governments because it's long gestation and its ROEs or ROCs are much lower than what private enterprises are willing to bet on. So I think in any case government only can build infrastructure. So right now, given that we have a complete demand destruction and we need someone from outside, who could actually supply demand to us, that could be government only. And the way to sort of spend money is actually build infrastructure. At least the way to sort of spend productively is to build an infrastructure. So my general view is that over the next couple of years, you will see a secular upturn in infra spend across the world. Developed worlds just spend about 2.5-3% in infrastructure. That number can rise to 4.5% over the next 3-4 years. And low interest rates, as such, would assist these governments to borrow money and actually build infrastructure. So big picture, I would see about $1 trillion extra being spent in infrastructure over the next 3 to 4 years. I'm talking of across the world, though.
So, Maneesh, closing comments. Now, typically how a market cycle or an economic cycle works is that first there is expansion and then there is a drop or a collapse, which will be followed by contraction, recession, bankruptcy, and risk capital would kick in. Now, when the bankruptcy or the contraction happens, that's the time blow-ups happen in the corporate market, in the debt market. We've seen some challenges which have happened in credit schemes also. Are you not worried about that cycle or that natural cycle getting played out?
We are worried. See, there are 2-3 things here. One, of course, as I said in the beginning, that policymakers are trying to make it painless, and it's instructive to hear what Pavel said on 17th May, the Fed chair, that until the healthcare system actually get a control of the virus, we ought to ensure that there are no bankruptcies and labor do not get dislocated. That's the template being used everywhere in the world. So I think governments everywhere are trying to postpone a bankruptcy only because of COVID-19. In India, too, these guarantee schemes, the 300,000 crore scheme for the MSME, I think that's going to be expanded, dramatically to ensure that no company goes down, or rather most companies don't go down because of the COVID-19 disruption. But nonetheless, it will happen, a couple of years out, when all these backstops would go away, maybe 1 or 2 years out, some of these franchises who are over-levered would actually start to struggle again and most probably would go down. But I think at least for 1.5 years, these remedies would actually ensure that, bankruptcies do not rise dramatically. Now, as far as the credit markets are concerned, we have to sort of take this into cognizance that India has had an industrial deleveraging underway for 5-6 years. Industry credit as a percentage of GDP is actually not risen. In fact, it's fallen quite sharply over the last 7-8 years' time. So as such, the new lending boom which paved way for big credit crisis in 2014 onwards, actually, that did not happen at all. So to that extent, I think at least the industrial complex, the big corporate bankruptcies may have already peaked for us, and maybe few cases here and there, but I don't anticipate major bankruptcies on the industrial side. What I'm actually worried right now is that because COVID-19 has resulted in large unemployment, income losses for people, there is a risk that the retail actually begin to misbehave. And remember that the retail is the one which has actually levered up quite substantially in India over the last couple of years' time. So that's the big picture on bankruptcy. As far as our credit funds are concerned, we've seen, of course, trouble. Majority of us have had, few accidents here and there. But I think outside of Franklin, pretty much across the credit funds, fund managers have managed it well. They managed the liquidity despite substantial drawdowns in AUMs. Actually, we've all have returned money to investors, and I think incrementally, there is little risk. I think of any blow up across credit funds.
Maneesh, fantastic to have you back. Stay safe, my friend, and certainly hope to see much more of you going forward. It's taken us a lot of convincing to convince Maneesh Dani to finally come on air, but appreciate your time.